The U.S. stock market has been extremely volatile this year, and there are a number of different factors that come into that, whether it be the Russian-Ukraine war, inflation, fears of a recession. But I think one of the main things, if not the number one reason for the stock market volatility this year, has been the Federal Reserve. And so let's go ahead and get into this. And so in this video, I am going to explain to you guys how exactly the Federal Reserve impacts the stock market and why the stock market seems to react very strongly to pretty much anything the Fed does and says. And so let's go ahead and get right into this video. First, let's go ahead and define what exactly the Federal Reserve even is, right? So despite its name, which I know can be extremely confusing, the Federal Reserve actually isn't a federal institution. It's technically an independently run entity. It is a private bank leading the U.S. central banking system, which is composed of 12 smaller regional banks. Now, the Federal Reserve was actually created to conduct the nation's monetary policy as well as provide stability to the financial system. The Federal Reserve was actually founded by Congress in 1913 in order to prevent financial panics and economic disruptions caused by bank failures and bankruptcies. Now, in 1971, when the dollar left the gold standard, the Federal Reserve was actually given the power to control interest rates and inflation. And while Congress must first approve the spending, the Fed has the power to essentially prop up the economy at any given time as they see fit. They have that power. Now, the activity that has the most direct impact on the stock market actually occurs 8 times in a year when the Federal Open Market Committee meets. Some of you guys may know this as the FOMC meeting that always takes place ever so often, where the Fed basically says, this is how much we're hiking rates this time, and, you know, the Fed meeting minutes and all that stuff. Now, while these meetings are closed to the public, the FOMC meeting minutes are actually released a little bit later after the meeting and provide details of what was discussed in the actual meeting. Now, the way the Fed adjusts the speed of the economy is with interest rates. If the economy is growing too fast or inflation appears to be growing, the Fed will raise interest rates. Now, higher interest rates tend to slow business growth and consumer spending. If the economy is slowing too much, then the Fed can lower interest rates, which makes it cheaper to borrow, and that encourages businesses to expand and customers to spend. Now, how exactly do interest rates affect stocks? Well, it makes it more expensive for companies to borrow money, and this could therefore reduce future profits and result in lower revenues. You see, when interest rates rise, it's harder for companies to borrow, and it then becomes more costly to manage the debt that they already have, which actually impacts their ability to grow. Furthermore, the stock market reacts to the changes in the interest rates because it generally signals whether or not the economy is strong, and that could also have an impact on a company's cost of doing business, thus changing how investors may value a company. This is because of the impact that interest rates have on the stock market. Now, the other reason is the markets are always forward looking, and this is why interest rate hike periods are almost always followed by tons of volatility in the market, because investors essentially digest what's going on, determine how they feel, and they make a fairly quick and sudden reaction to that, and that can be in the form of immediately selling stocks if they're not happy with what the Fed is doing, and that is actually what we have essentially seen this year. This was also the case at various points in 2018 and also in 2020, which was the opposite. So you saw this in 2018 where the Fed raised interest rates. The stock market did not like that. And you also saw this in 2020 where we had essentially the shortest bear market ever during the pandemic, where the Fed came out and said that they would be lowering rates and doing quantitative easing. And the market really liked that. So the market immediately rallied, and we essentially had a 2-month bear market, which I believe is the shortest bear market in history. And so, yeah, I think that's it. And yeah, I guess that's it. Short, sweet, and to the point. So there you guys have it. That'll go and conclude today's video. Thank you guys so much for watching. Feel free to like, share, and subscribe, and I will see you guys in the next one.